All right, welcome back. Today we're diving deep into one of the biggest questions in investing. Where are those massive, life-changing gains? Well, a lot of them happen in a world most of us never get to see, long before a company's stock ticker ever flashes across our screens. Yeah, we're talking about the pre-IPO game.
And this quote right here, man, it really hits home for so many everyday investors, doesn't it? You hear about a hot IPO, you get all hyped up, you rush to buy on day one, and then you're left wondering, why am I not seeing that explosive growth the insiders got? Well, it's because, in a lot of ways, the party was already winding down by the time you even got the invitation.
Just take a look at this. This slide tells such a powerful story using Airbnb's public debut. The company sold its first batch of shares to the big institutions for $68 a pop. But then, look what happens next. The very first trade on the public market was at $146. That's a 115% jump, instantly. For Airbnb, that's millions of dollars in cash just left on the table. And for regular investors, it meant paying a massive premium just to get in the door.
So what's going on here? Why does this happen? Is the system just broken? Well, not exactly. This IPO pop isn't some kind of bug, it's a carefully designed feature of a system that has for a very long time prioritized the big, institutional players over you and me.
And the machine behind this is a process called book building. You can think of it like an exclusive, invitation-only auction. The investment banks running the show go to their biggest clients. We're talking giant hedge funds, massive pension funds, and they basically ask, hey, what price would make you willing to take a risk on this new, unproven company? The whole goal is to set a price that's just sweet enough to reward these big players for putting their money on the line first.
And this, right here, perfectly illustrates the two-tiered system at play. The institutions, they get first dibs, buying at that special price they help set. Then the stock hits the public market, and there's this frenzy of demand from regular people. So who are we buying from? A lot of the time, it's those very same institutions who are just flipping their shares for a quick and often massive profit.
But hold on, because the IPO is actually pretty late in the game. To get the full picture, we have to go back even further. We need to peek into the layer between the earliest investors and the public offering. This is the hidden world of the secondary market, where shares of giants like Stripe and SpaceX are bought and sold long before they ever dream of hitting the NASDAQ.
So what on earth is this secondary market? Well, you can think of it like a stock market, but for private companies. You've got platforms like Forge and Hive that connect employees or early venture capitalists, people who want to cash out some of their stock, with accredited investors who are dying to get in. The sellers get much-needed cash for an asset that might be locked up for years. And the buyers, they get a chance to own a piece of a high-growth company, often at a discount to its last official funding round. This is where the real hunt for pre-IPO alpha happens.
But, and I need to be crystal clear here, this is the Wild West of investing. First, you've got something called the right of first refusal, or ROFR. That means the company itself gets the final say and could just block your purchase or even buy the shares for itself. Second, there is an absolute lack of transparency. You're making huge financial decisions based on very limited, often unaudited information. And the biggest, most brutal truth, there is zero guarantee the company will ever go public. Your money could be trapped for a decade, or if the company goes under, it could just vanish.
So all this frustration with the traditional IPO process, the money left on the table, the insider access, the crazy fees, it's led companies to start looking for totally new ways to enter the public markets.
And in response to all these problems, two main alternatives have really shaken things up in the last few years. We're talking about direct listings and SPACs. And they each offer a very different path to the exact same destination, becoming a publicly traded company.
Okay, so a direct listing is pretty much what it sounds like. Instead of creating and selling new shares to raise a bunch of money, the company simply lists its existing shares on an exchange. This is basically a path for insiders, founders, employees, the early investors to cash out. You saw companies like Spotify and Palantir do this. The idea is simple. Why should we give big investors a discount? Let's just list our shares and let plain old supply and demand set the price from the very first trade.
And then you have SPACs, the so-called blank check companies. It works like this. A shell company goes public to raise a big pile of cash. It has no operations, nothing, just the money and a promise to find a private company to merge with. For that private company, it's a much faster way to go public. And here's the crucial detail that makes SPACs so tempting. They can market themselves using forward-looking financial projections, predicting future revenue and growth. That is strictly forbidden in a traditional IPO, giving SPACs a really powerful storytelling advantage.
This table really lays it all out, side by side. Just look at the primary goal. A traditional IPO is all about raising fresh capital for the company. A direct listing, nope, it's about letting existing shareholders sell their stock. And a SPAC's goal is to take a private company public through a merger. This fundamental difference in purpose changes everything: who sells, how the price is set, and it leads to those key features, like the IPO pop versus the no lockup period you see in a direct listing.
Okay, so what's the bottom line here? What does all of this mean for you, the individual investor? Well, it means you really need to fundamentally change how you think about a company going public.
This right here might be the single most important takeaway from our whole conversation. For years, we've been taught to see an IPO as a company's big debut, the start of its public journey. But more and more, it's actually the end of one journey. It's the moment where the founders and early VCs who took all that initial risk can finally cash out. It is their exit strategy.
So from now on, when you see a headline about the next big IPO, see it for what it is: a liquidity event. Recognize that this whole other game, the secondary market, has been playing out for years, but it is a high-stakes arena with its own rules and its own dangers. And finally, know that the path a company takes to go public, whether it's a traditional IPO, a direct listing, or a SPAC, tells you a whole lot about its goals and, more importantly, who really stands to benefit the most.
So the next time you see all the confetti and hear that opening bell ring on Wall Street, you're going to have a totally different perspective. You'll know the game behind the game, and maybe even the secret game behind that one. The only question left is, how is that going to change your approach? Thanks for joining us.